Hello, I'm Carey Cooley.
And I'm Brent Kerwecker.
Today we will be providing a brief overview of the stock market's performance for the first half of this year.
Yes, for the first half of 2023, we've seen the stock market roar back with all three major indexes showing sizable gains. Through June of 2023, the major indexes finished as follows. The Dow up 3.84, the S&P 500 up 16.9%, and the Nasdaq continuing to lead the charge up 32.74%. The U.S. Aggregate Bond Index is up 2.1%. And I just want to talk about bonds a minute. Bonds are not tied to the stock market. They're tied to interest rates. And when rates go up, bond prices go down. So be watching for when the Fed starts to hint at reducing rates, and that will have a positive impact on the bond market.
Inflation has continued to steadily decline, dropping to 3% on an annual basis compared to 8% a year ago. Rising interest rates have been the theme for 2023. The Fed and other major global central banks remain hawkish, with more work to do in their fights against inflation, increasing risks of eventual recession. Even with an improving price outlook and better than anticipated earnings, the global economic and geopolitical landscapes remain challenging.
Large and small cap stocks have delivered gains during the second quarter. However, large caps continued their outperformance on the back of strong performance from the consumer discretionary sector and technology sector. Year to date, large caps have more than doubled their small cap counterparts, 16.7% to 8.1%.
Core bonds, as defined by the Bloomberg U.S. Aggregate Index, lost ground during the quarter as central banks' hawkishness pushed rates higher. The 0.8% decline for the index in the second quarter brought the first half gain down to 2.1%.
Our outlook for the remainder of the year is that the U.S. economy tips into a recession toward the end of 2023 as consumer spending fades. A cooling job market could be the impetus for a modest economic contraction if consumers face declines in disposable income. The Fed is expected to end its rate hiking campaign soon as inflation cools further.
We see modest second half gains for stocks as first half gains have left valuations elevated and stocks overbought from a technical analysis perspective. That said, corporate America resilience has been impressive. The Fed's rate hiking campaign is nearly over, and the latest economic data has increased the odds of a soft landing for the U.S. economy.
Many of our clients have been inquiring about artificial intelligence and how to invest in this sector. I liken the rollout of artificial intelligence, also known as AI, to the rollout of the internet in the late 90s and early 2000s. Artificial intelligence is not a technology owned by any single company that you can invest in. Rather, it is a tool that will be used by many industries, changing how things get done. The technology is in its early stages and will evolve just as the internet has evolved over the last 25 years. Nearly all of our clients have investments that own companies that are or will benefit from AI. To date, the semiconductor industry has benefited the most from a financial perspective, with the sector being up on average 45% just through the first half of this year alone. At Cooley Godfrey Investment Group, we do have specific funds that are dedicated to investing in this sector. If you'd like to learn more, please call to schedule an appointment with Carey or myself.
Thank you for watching this month's video, and please subscribe and like for future upcoming events and videos and information from Cooley Godfrey Investment Group.